Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Lumen Technologies stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Lumen Technologies is a telecommunications company. It is one of the largest US communications providers to global enterprise customers. Its communication services include local and long-distance voice, broadband, Ethernet, video, network, information technology, and much more. It has customers in more than 60 countries. In September of 2020, CenturyLink announced that it had changed its name to Lumen Technologies. The stock ticker changed from CTL to LUMN. The main reason the company changed its name to Lumen was to get a fresh start and to hopefully move away from CenturyLink's past struggles. For a long time, people viewed CenturyLink as an old company with outdated technology. Although CenturyLink will continue to be the customer-facing brand for traditional copper-based services. A copper-based internet connection is a standard connection type that has been used for over 100 years. Now that the company is moving into the 21st century, it has a lot of fiber-based products and services. Those services will be sold by the brand name Quantum Fiber. The reason CenturyLink merged with Level 3 in 2016 was to capitalize on the more advanced fiber technology. The merger with Level 3 really helped advance this company's technology. Lumen has laid down 450,000 miles of fiber network. By laying down all this infrastructure, the company received a lot of tax subsidies. And all this infrastructure they built out are assets that they can use and they could potentially sell in the future. The company is headquartered in Monroe, Louisiana, and was founded in 1930. It can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 14 billion market cap. They're trading at $13 a share and they have 1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have lots of free cash flow, around $3 to $4 billion a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that doesn't look so good. It's negative every year. Revenue is a sales for the company, and that's been declining from 23 billion down to 20 billion. This is the company's income statement from Yahoo Finance. Later on, we're going to look at their income statement from their most recent 10Q. The top line is the revenue, the sales. Here's a breakdown of their revenue from 2018, 19, and 20. They sell all over the world, so 3.4 billion is from outside the United States. The biggest revenue generator is from large enterprises, 5.7 billion. This could be for big companies like Google or it could be for entities like the US government. Then you have small and medium businesses, 2.6 billion. They do 3.8 billion in wholesale. This is products sold through telecom providers or regional carriers. And they also sell to consumers like me and you, 5.3 billion. Their revenue is really high, over 20 billion, but it is going down in most categories. Below revenue is a cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2018 and seems to be going down each year, similar to the revenue. Then below that is operating expenses, then their operating income. And they had their highest operating income in the trailing 12 months, so that's a really good sign. They're becoming more efficient. They do have a lot of debt, so they pay a lot of interest on their debt, but that's going down. It was 2.2 billion, now it's 1.5 billion. They've been shedding their debt each year. And the bottom line of the income statement is their net income, which is negative every year, which may look like a big red flag, but I would focus on operating income, which is positive every year. The reason they have negative net income is because they're passing through large goodwill impairments. This is from their 10K. You can see they passed through really big impairments, 2.7 billion in 2018, and they had a $1.7 billion loss. So if they didn't have this impairment, they would have had a gain. Same thing in 2019, the impairment was larger than the net loss. Also in 2020. A goodwill impairment is when you write down the value of a business that you acquired in the past. A lot of their older businesses are getting written down, probably because the technology is older. So they're passing through the loss this year, but the loss should have been passed through years ago when they acquired the company. This is from their 10K. It talks about the goodwill impairment write-downs. I'm not going to go through this, but you can pause the video if you want to read this. This is the income statement from their most recent 10Q, the 9/30/2021 10Q. And you can see there's a net profit in both years. That just implies they're passing through the impairments in the fourth quarter of each year. That's why they have negative net income for the entire year. But for the first 9 months, they have positive net income. The top line is the revenue, the sales, and that went from $15.6 billion down to $14.8 billion. Here's a breakdown of their revenue. They had the most in international, $3 billion, $2.8 billion in large enterprises. Mid-market enterprises was $2 billion, wholesale was $2.7 billion, and mass markets is $4.2 billion. Mass markets are consumers and small businesses. Below revenue is their expenses. They had $6.4 billion in cost of services and products. These are employee expenses such as salaries, wages, benefits, and fees, expenses of their facilities, rents and utility expenses, and also equipment expenses. They had $2.2 billion in SG&A. Employee expenses are in multiple buckets depending on what the employee does at the company. So this also has employee-related expenses, marketing and advertising expenses, property and taxes, litigation fees, and bad debt expenses. A bad debt expense can occur when a customer is unable to pay their invoice, maybe due to bankruptcy. And as you can imagine, they have tons of depreciation because of all the fixed assets on their balance sheet. So that was $3.1 billion. So they do have positive operating income in both time periods, and also positive net income in both time periods. So it looks like there is a chance they will have positive net income in 2021, assuming they don't pass through a large goodwill impairment in the fourth quarter. If they do have a really big net profit, maybe their stock will go up a lot. This is a statement of cash flows from Yahoo Finance. We're going to look at the 10Q in a little bit. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generate tons of cash flow, $6.5 to $7 billion a year. Of course, they have lots of CapEx because they're always laying down infrastructure. That's around $3 to $4 billion a year. Operating cash flow minus CapEx gives you your free cash flow, and they have tons of free cash flow left over. That's why they pay a really nice dividend. They're also paying down debt. Every year they pay down more debt than they issue. This is their operating cash flow from their 10Q. This shows the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. We have to add back the $3.1 billion of depreciation because that's a non-cash item that brings down your net income. They also pass through $431 million deferred income taxes. Deferred income taxes are taxes a company will eventually pay but are not due today. And the reason deferred income taxes come about is a difference between the way the IRS and GAAP calculates taxes. Then you have to adjust for changes in working capital. So even though they reported a $1.5 billion gain, they actually generated close to $5 billion of cash flow. The second section of the statement of cash flows is cash flow from investing, and that's mainly CapEx, investments in property, plant, and equipment. They did have a small amount of sales of CapEx, $90 million in 2021 and $119 million in 2020, but those dollar amounts are pretty negligible. And then the last section is cash flow from financing. They received $1.9 billion from issuing debt, and they paid down $2.6 billion of debt. They paid $834 million in dividend payments, and they bought back $909 million of stock. We did not see share buybacks on the Yahoo Finance statement of cash flows. That's why it's good to look at the company's financials, because that's where all the information lies. That's where everybody gets their info. This is the equity section of their balance sheet. They have $11 billion of equity. They raised $19 billion from selling their business, and they lost $6.5 billion from running their business. Accumulated deficit is the sum of all your prior net incomes minus the sum of all the dividends you paid out. It's not a good sign historically they're running a loss, but I think a lot of it is due to all those goodwill impairments they're passing through. Once they clean up their balance sheet and get rid of the unprofitable companies, I think they'll be much stronger going forward. And they have negative 2.6 billion in accumulated other comprehensive income. These are unrealized losses that have yet to be satisfied. Here's a breakdown of their accumulated other comprehensive income, and most of it is in pension plans, negative 2.2 billion. When you invest in a company with lots of employees that pay a pension plan, there is a chance that that pension will drag down the company's profits, because the company has to fund these pension plans to pay their old employees. So this indicates they may have to pass through a $2 billion loss on this pension plan sometime in the future. That may not happen. It's kind of like if you own a stock and you're down $10,000. Say you invested $30,000 and the value of that stock is $20,000 today. You didn't lose $10,000 until you sold it. Same thing with this. They never actually paid out this $2 billion. They are paying pensions to their ex-employees, but they haven't realized this large loss yet. And the company does mention in their quarterly report, we do not expect any contributions to be required for a qualified pension plan during 2021. There are two types of contributions, required and voluntary. If it's required, the company has to make it. They do mention we could make a voluntary contribution to the trust in 2021. Let's look at their capital structure. They have 11 billion of equity, 30 billion of debt. So they're 27% equity, 73% debt. So you can see the company is really leveraged. I think that's what's really pushing down the stock price. People don't like all this debt, but they are doing a good job at paying down their debt, and they're divesting some of their businesses. We'll talk about some of those in a little bit. I gave them the highest whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 51 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $47 billion. We divide that by 1 billion shares. And we get a calculated stock price of $46. They're trading at $13, so they're trading at a 71% discount. It's a really strong buy according to the model. The average analyst projects their revenue to decrease 7%. So to get their future revenue estimates, I decreased it 7% for the next 4 years. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers, and that comes out to 15.5%. So I multiplied their future revenue estimates by 15.5%. That's how I got their future free cash flows. And I'm still coming out of the stock price a lot higher than they're trading at. The problem with this stock is investors look towards the future, and they see the future being pretty dismal for this company. So that's why they're not buying the stock now and pushing the price higher. They're pushing the price lower. So you can have a company with much less revenue that is trading at a higher market cap than a company with much higher revenue. To give you an example, they're at 20 billion of revenue. And say there was a similar company with 1 billion of revenue. And the projection is for that 1 billion revenue company to grow 10% a year, and this company to decrease 10% a year. This is a pretty aggressive scenario because I don't think they're going to decrease 10% a year for the next 10 years, but let's just say they do. Even after 10 years, which is a long time, most people don't hold stocks for nearly that long, their revenue would still be triple this $1 billion company. And I'm giving the worst case scenario. Revenue is not the main thing. You also have to look at margins. We saw on the income statement their operating margin was highest in the trailing 12 months because they got rid of those inefficient businesses. So when you invest in a company that you think has a good future that others don't, you may have to wait several years for the rest of the investing community to see what you see. They will come around, but it could take 5, 6, 7 years, and most people can't sit on an investment that long. Most people get stressed out after 1 week seeing the stock go down, let alone 5, 6 years. The company is divesting 2 of its business units, one of them for $7.5 billion. That's located in 20 US states. That should occur in the second half of 2022. They're selling another business unit for $2.7 billion. That's in the Latin American division. That should occur in the first half of 2022. And you can see their pre-tax net income for those 2 units in the 3 months ended 9/30 and the 9 months ended 9/30. Surprisingly, Simply Wall Street is really bearish on this stock. Their valuation is $6. They're saying it's 108% overvalued. 3 analysts priced this stock and the average price target was $12. So you can see the stock has struggled over the years. It seems like it keeps going down. It dropped to its lowest point in the middle of 2019. It has come up since then, but not too much. It's just been up and down, up and down. And there was a ton of buying activity on this day. I wonder if this was a short squeeze. Most telecom stocks have a low beta. Their beta is 1, so the stock moves with the market. It's gone up 27% in the past 52 weeks, while the S&P is up 31%. But if you add their dividend, it's up more than the S&P. The 52-week low was $10, the high was $17. And the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. 11 million shares have been traded each day on average the past 3 months. Of the 1 billion shares outstanding, 900 million are on float, 82% are held by institutions, and 11% of the shares are shorted. And their employee count has been decreasing. It looks like it was about 48,000 in 2018, but they've been selling off their inefficient divisions and they're becoming more profitable. So their employee count is 37,000 today. The reason this stock is so popular is because they pay an amazing dividend, 7.5%. And the way you calculate the dividend, you could just multiply the last dividend payment by 4, take that number, which is $1, and divide by the stock price. And the lower the stock price goes, the higher the dividend yield. And we can't look at that payout ratio since they have negative net income, but they pay out 27% of their free cash flow. So they have a lot of room left to pay down debt. Their industry pays a 6.7% dividend, and they're higher than their industry. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $8,300 today. That's a 17% loss. But it's not a loss unless you sell the stock. If you're still holding, you're collecting your dividend payments. In the past year, there's been 4 insider sells and 2 buys. But one of the buys was huge, 2.3 million shares. The biggest shareholder is Vanguard at 12%. The next biggest is 9.5%, then BlackRock, Southeastern, and State Street. Let's look at their financial ratios. We can't look at the PE since they have negative net income. But if we stripped out the goodwill impairment, their PE will be below 10. They have an amazing price to sales of 0.7. That means their revenue is higher than their market cap. And their price to book is 1.2. Price to book is stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have 11 billion of equity. Negative 12 billion of tangible equity since they have 23 billion of intangibles on their balance sheet. Since they acquire so many companies, that's why they have so many intangibles on their balance sheet. They have a decent return on invested capital of 8%. Even though they have a lot of debt, they can cover their interest payments 2.5 times. They have a negative ROE since they have negative net income. And they have a good current ratio and quick ratio of 1.4. They don't have much cash on their balance sheet. They have 1.5 billion of accounts receivables and 8.7 billion of assets held for sale. These are assets that are going to be sold within the next 12 months and they're not depreciated. These are probably the assets of the business units they're divesting next year. So they do seem to be really well capitalized. They generated 3.8 billion of free cash flow in the trailing 12 months, 3.4 billion of working capital, and they paid out over 1 billion in dividend payments. So they have $6.1 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as Lumen. And you can see Lumen has a much better price to sales and price to book. They're higher in current ratio. They do have a negative ROE because of that goodwill impairment. One of the big concerns with lots of investors is their high amount of debt. But their market cap is so low compared to how much cash flow they're bringing in. Look at the operating cash flows of similar companies as a percent of their market cap, and you'll see what I mean. So to summarize, I have them trading at a 71% discount, and I do think this is a really good company. They provide telecommunication services to so many businesses. And that's a really valuable asset right there. And it's good to see they're trying to move forward and get newer, more advanced technology. But it could take a decade for other investors to really drive up the stock price. Most people are not willing to wait that long, but I'm pretty confident the stock will go up. I'm just not sure how long it's going to take. I ranked their free cash flows 8 out of 10, their revenue 5 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.